In 2008, the global financial system collapsed. Millions of people lost their homes, their jobs, and their savings. The banks that caused the collapse were bailed out with public money. And within 2 years, those same banks were posting record profits. That is not a coincidence. That is the system working exactly as it was designed to work when it fails. Here's what actually happened. Throughout the early 2000s, American banks were issuing mortgages to people who could not realistically afford them. These were called subprime mortgages. Banks knew the loans were risky. They did not care, because they were not planning to hold on to them. Instead, they bundled thousands of these mortgages together into financial products called mortgage-backed securities and sold them to investors around the world. The risk left the bank's books the moment they sold the bundle. The fees stayed. To make this work at scale, banks needed the bundles to look safe. So they paid credit rating agencies to evaluate them. The rating agencies, who were paid by the same banks they were rating, gave toxic bundles of bad mortgages the highest possible safety rating. AAA, the same rating as US government bonds. Investors bought them believing they were safe. They were not. When the housing market started to crack in 2007, the value of these bundles collapsed. Banks that had kept some exposure on their own books started hemorrhaging money. In September 2008, Lehman Brothers collapsed. The entire system seized up overnight. At this point, governments had a choice: let the banks fail, which would have wiped out savings accounts and frozen the economy entirely, or bail them out using taxpayer money. They chose the bailout. The US government injected over $700 billion into the financial system through a program called TARP. The UK government spent equivalent billions doing the same. The argument was that these banks were too big to fail. Letting them collapse would hurt ordinary people more than saving them. What happened next is where the story becomes impossible to defend. The executives who ran these banks kept their jobs. Many kept their bonuses. The banks, now stabilized with public money, were able to borrow from central banks at near zero interest rates. They used that cheap money to buy assets at post-crash prices. Assets that had been devastated by the same crisis the banks caused. As the economy slowly recovered, those assets rose in value. The banks profited enormously. Meanwhile, 9 million Americans lost their homes to foreclosure. Unemployment peaked at 10%. Household wealth dropped by trillions. The people who caused the crisis were made whole. The people who suffered it were not. Not a single senior banking executive was jailed for their role in the 2008 financial crisis in the United States. One country jailed its bankers. Iceland. That is the next story. The 2008 crash did not break the system. It revealed exactly how the system was designed to work when things go wrong. Losses are socialized, profits are privatized. And the people at the top remain at the top regardless of the damage they cause.